This presentation is for information purposes only and doesn't constitute investment advice nor an offer, solicitation, or recommendation to acquire or dispose of any investment or to engage in any other transaction. All descriptions, examples, and calculations contained in this publication are for illustrative purposes only. The risk of loss in trading foreign exchange, futures, cryptos, and equity markets can be substantial. You should therefore carefully consider whether such trading is suitable for you in light of your financial condition. Past performance is not indicative of future results. Hi, my name is Ahmed. Welcome to lecture 4, final lecture of the basic introductory workshop, and one of the most important as well. And it has really nothing to do with experienced traders or novice trader, because this is one of the basic thing which deals with the basic risk management, position sizing, basic trade plan, and trading journal. We will be discussing all these here in this fourth and final session. So let's start with some of the basic terminologies involved to understand what measures should be taken to finally gauge the risk and the position sizing, and what should be the trade plan and stuff like that. ROI, return on investment, is measured as a percentage of capital gained versus the amount of risk capital. Professional risk management. The successful trader has a handle on what percentage of trading capital they are willing to risk per trade, which generally we recommend initially between 1% to 3% of their portfolio size. And this risk should be per day, per week, and per month, and must be measured in percentage to the investment. A fixed tick stop is considered risk management by lazy traders. The price action will dictate not only your initial target, but also the appropriate stop. Trade expectancy. Trade expectancy equals average profit into probability of winning trades minus average loss into probability of losing. In other words, trade expectancy is the average amount per trade that the trader can expect his method to produce over the long run. Reward to risk ratio. The reward to risk ratio can also be referred to as the risk to reward ratio or the profit to loss ratio. Essentially, the ratio just looks at the profit or reward and compares it to loss or risk. For example, if the reward was 2 points and the risk or initial stop is 1 point, then the reward to risk ratio would be 2 to 1. Percent winners. A high percent winners does not guarantee a system or trading methodology will be successful. There can be losing systems with 90% winning trades. A low percent winners does not guarantee a system or trading methodology is a loser. There are profitable trading methodologies with a 30% winning percentage. So it doesn't really depend upon only this factor. Stops. There are two categories of stops. One is initial stop and second is trailing stop. The initial stop is self-explanatory. It is the first stop order placed after you enter your trade, and we strongly recommend placing a stop in conjunction with or immediately after a position is entered. This is also known as walkaway stop. in case you will have to be away from your terminal. The trailing stop is a stop that is moved as the trade progresses. It could be in profit size. Next is position sizing. Before that, let me quickly wrap up initial few concepts we just went through. That a successful trading system should be based on ROI, where we set certain percentage of risk per trade and we fix it. For example, if we make a 2% risk and we are trading, for example, $100,000 account, it means risk per trade should never exceed more than $2,000. Once we lock this, second step is to have a fixed reward to risk ratio. Whatever we prefer, if you go for minimum 1-to-1, means if in a trade you are prepared to have $2,000 risk, so it means there should be a profit potential of minimum 2,000 or more. This is 1-to-1 reward to risk ratio. So after understanding these two concepts, let's move forward to this third one, position size. That once we have locked, for example, we'll go with 2% risk per trade and our reward to risk ratio is, for example, minimum 1-to-1 or better. After that, what should be the position size? If a trader keeps the same position size for every trade, then they are not risking the same percentage on every trade. A professional trader varies the number of contracts per trade, thereby keeping the dollar risk per trade constant. For example, if the trader is having a $50,000 account and is willing to risk 2% per trade, the trader therefore is risking $1,000 per trade. So trader will calculate on each and every entry the number of contract or lots differently based upon risk per trade, which is based on equity before every trade and in line with the reward to risk ratio. Just for example, as you can see here, this example of mini S&P, where the risk as per 2% of the $50,000 account is $1,000. So based upon it and based upon price action, which we just studied in the third lecture, which was very much important as far as the forecasting is concerned. So if our stop is 5 pips away, we'll go for 4 contracts, and so on. If the stop is decreased based upon the price action movement, what charts are telling us, if it comes, for example, 2 points, we may increase this to 10 contracts, because 10 contracts into 2 point equal $1,000. So in every transaction we are risking $1,000 here, $1,000 here, so on. So we will definitely change the number of contracts based upon our stop, and the stop is of course based upon price action movement, what charts are giving us. So this is how, in conjunction with risk per trade and ROI and risk to reward ratio, we calculate the professional position sizing. So these 3 points are the barriers which control our emotions and help us in profitable trading, and these are very much important and essentially vital requirements which nobody should negate. Risk per trade as percentage of account. Now let's discuss this in more detail. Another benefit of basing your risk per trade on a percentage of your account is that it manages your dollar risk per trade in proportion to the growth or shrinkages of the account. Let's say a trader has a $50,000 account and they are willing to risk one person per trade. That would equate the $500 of risk per trade. If their account shrinks to $40,000 and the risk per trade is kept constant, then they will only be risking $400 per trade at this stage instead of $500. As their account suffers a drawdown, the account will decrease at a slower dollar amount versus if they just kept trading a fixed dollar stop loss throughout the whole process. Similarly, if their account grows from $50,000 to $60,000 and they keep the percentage per trade at 1%, they will be risking $600 per trade at this point. So as the account grows, the dollar amount risked per trade grows and their account grows faster on a dollar by dollar basis. Let's examine it through this chart. Here on left side you see this is a losing streak. Just in case, we presume he starts with $50,000 account, and in this column you see there is a fixed dollar risk per trade which is $500, and in this column is risking 1%, which for initial trade would be 500, but as equity decreases, this 1% amount will decrease from 500. So in this case, if we examine, if we have a losing streak of 50 trades, means we lost in every trade and we made 50 trades, then we see the equity from 50,000 will be reduced on every transaction by 500, 500, 500, so on. After 50 trades, it will be $25,000 left in the account. On the other side, when we risk it against percentage, which is 1% here, so in first trade, after loss, equity becomes 49,500. But after that, it will be decreasing because for the next trade, we have less than $500. So on, after 50 trades, we examine, the account will still be at $30,250, which is much higher than the fixed one. So in case of shrinkages and losses in the account, we see it is having less loss. Now on the other side, if we study and examine the winning streaks of 50 trades, this is the fixed $500 profit and this is 1% every trade. So after every trade here in fixed method, $500 is being added, and on the other side you see it will be increasing on every transaction, and after 50 trades here we will have $75,000 in fixed scenario, and in 1% risk per trade we will have $82,232. So in case of profit we have more profits, and in case of loss we have less loss. So this is the basic benefit of risking per trade on percentage basis. So after having these three important steps in our mind, let's proceed with the basics of a trade plan. Trade plan is like a business plan for any other businesses, and it must be well prior written and should not only remain in your mind like most of the novice traders due to lack of discipline. Professional traders manage their emotions for a rational trading plan. You can't manage your emotions without writing your sentiments, actions, and possible remedies. Just by opening an account and calling yourself a trader, is it that easy to become a professional trader? Can you become a doctor, engineer, chartered accountant, even web developer or electrician like this? This is a challenging career, and you need to take every possible step to become a professional trader. Successful trade plan is actually the selection of right goals to achieve your target. And you can't hit a target if you can't see it. And you can't see a target if you don't have it. And you can't have a target if you don't dream it. So this is a process. There are 3 pillars of a trade plan, which basically comprise our feedback loop, which helps us not only in building the trade plan, rather strengthening and updating the trade plan based upon our activities. First one, writing your trade plan. Then trading log. And finally, trading journal. Let's discuss these in detail. How we can fine-tune our trade plan until we don't practice it, until we don't see the outcomes, until we don't realize what are the mistakes made. Here we can have the improvements, how we can improve it, which area is weak. All these questions can only be addressed once we apply the trade plan. Once we have the trade plan, we execute trades as per our plan. Some of the factors we already discussed, we know, okay, we will risk 1% per trade, okay, we will not go for any trade if reward to risk ratio is less than 1:1, so on, and some other measures. Once we execute, then we write trade log and trade journal. Based upon it, we constantly review these things, and it helps to fine-tune our trade plan gradually. It's an ongoing process. This is very important to understand. How we build the trading pyramid, you see, we have the trade plan combined with the proper risk management, which we just studied, risk-based, percentage-based, position sizing, ROI, risk to reward ratio, and other factors. Then the trading psychology, which comes after the trading journal. We realize our mistakes. We see what is our personality, how we feel comfortable, which product we feel more comfortable, which timings, and other factors. Then we made entry and exit rules based upon the price action and other stuff. So all these things made basically the trading cycle, which is a constant working. The basic elements of a trade plan are: what are our goals? The goal setting. Are we trading for our monthly earning, or it's a growth related stuff, or what is our risk appetite, what is our objective, all these stuff. Then logistics, which broker, which country, which platform, so on. Markets, which products do we need to trade based upon our attitude and aptitude and risk appetite and compatibility and many other factors. What are our trading strategies? What risk we have? Risk per trade, risk per day, risk per week, overall drawdown, all these stuff. Then the trading psychology, which specifically deals with our nature and our inputs. And after continuous working with our trade plan and the trading journal, we see which things we are having, fear and greed and stuff like that, how we can overcome. Once we write all these things, we constantly upgrade them. Then the proper education, like you are going through some of the basics. So we keep on having more and more information and videos and knowledge. And this is an ongoing process which comprise a trade plan. Plan your trade and trade your plan. Actually, this was the title of one of my workshops in London, where first part deals with the trade plan, which mainly comprises following. So we study this. I name it 3 W's. W1, what to trade. This deal with the selection of the portfolio, refers to which asset classes you choose to study on regular basis to include in your trading basket. While making this selection, you need to consult your mantra as well. Otherwise, you might be wasting your time if you selected, incompatible products, not suited well to your financial objectives based upon your financial situation, available trading time, full-time or part-time activity, risky or more volatile instruments or trading methods, whatever. So W1 deals with what to trade. W2, what is my opening trade strategy? As we know, in a trading cycle, there are two halves, opening trade and closing trade. We must have well-written trading strategies for both. So, for opening half, it involves in-depth knowledge, continuous research and study of technical analysis, along with an eye on major economic indicators that might affect the particular asset class or product, risk-reward ratios, professional position sizing, risk per trade, overall drawdown limits, so on, along with your risk mitigation countering strategy, well written in your Excel trade plan sheet, which we'll be discussing in prior slides, to take the decision of opening the particular trading transaction or any other information you feel more appropriate. This must be written again and you should have constant brainstorming on it to fine-tune them. Finally, W3, what is my closing trade strategies? Again, it requires in-depth knowledge, continuous research and study of technical analysis, an eye on major economic indicators affecting the particular asset class, well-defined stop-loss point, walk-away stop, and trailing stop if it might be a multi-target trade based upon price action. For more details, you need to see my other videos which deals with the trailing stop. Remember common saying, ideal stop never hits. It's a wrong emotional sentiment, and to trade professionally and rationally, you will always have to avoid such things which give you either fear or greed to have a rational trade plan for successful trading activity. Now the second part of plan your trade and trade your plan simply deals with the right execution of the plan which you made yourself for the execution without giving any space to greed or fear, which is generally called tick fear as well, because once your position is open and if you constantly watch the market, it gives you a fear on every tick. And only by watching, you cannot reduce risk at all. You can avoid this initially in one way by placing a walkaway stop and just relax. That's maximum what you can lose. After all your studies, this is what you already done. And putting the T1, profit target 1, in your online trading platform and switch off your system and relax. As you're watching this screen will not turn your open position into profit. Rather, it will develop tick fear and create hurdles in execution of your own professional plan, which won't ever give you the confidence over life, as you would be unable to develop and adopt any trading system for your trading activity. Remember, you are not supposed to have profits in all the trades, and if your trade expectancy is even 50%, yet you can make huge profits in your career if you develop a stringent trade plan and stick to it and keep on improving through your trading journal, which we'll just discuss. Trading journal, the last topic of today's session. It's common saying, learn from your mistakes. You won't be able to learn from your past mistakes or experience whether it's good or bad until you make a habit of noting all these down in a well-written journal, which must be updated daily, weekly, or as you trade. There is one very important part which we call feedback loop, which requires both trading log and trading journal. Without this, you cannot excel in your trading career professionally, for which you just need to be a disciplined trader, keeping yourself away from the traditional laziness which is causing failure to most of the unsuccessful traders around the globe, turning all the efforts made to learn this vital education useless in the end. Now let's discuss some of the major elements which must be added in your trading journal. You can have as many as you want. These are some of the basic which I personally used, and in a separate video I'll go through the Excel sheet which I made based upon all these factors which we just studied. You should have a trade number, the date, the product instrument, average entry price, entry strategy, entry time, opening type, whether it's long or short, main chart time frame, which you use to initiate that particular trade, whether you made a decision on 4-hour chart or hourly chart or daily, whatever it is. Then the daily trend. You should know if it's a bullish market, are you going to buy or sell? Based upon other factors, you should have this additional. Then the first profit target limit, T1, T2, second limit, SL, walkaway stop, trailing stop, reward to risk ratio, trade expectancy. For example, if its reward to risk ratio is 1:1, so it means the trade expectancy is say 40%. So if it's less than that, you should stop and you should not go for that particular trade. This is the way you manage your emotions and keeping you away from any sentiments to have a rational trade plan. Then the position sizing, as we just discussed in this session, if it's percentage based, if you fix 2% risk per trade, so based upon it, how many number of lots should be entered in that particular trade. We're talking about only one transaction. Then trading category. It's a day trading, swing trading, position trading, whatever it is. You should know what you are planning to do with that particular product. Average closing price. Once this is closed. Why we use the word average? Because it might be a multi-target trade where you have T1. Then pips. How many points you made or lost. Then risk per trade, weekly trend, whether it was bullish or bearish or neutral to bullish or neutral to bearish or whatever. How many dollars you are paying as a round turn commission per transaction. Exit time, exit strategy, which technical indicator you based, which study you were based on. Then trade duration, so that you could know roughly in how many hours you are completing a transaction. Then very important, screenshots, which generally are neglected. Whenever you enter for a trade, just take a screenshot of the trading platform, likewise on exiting as well, and save them with some basics inputs. For example, let me quickly jump to show you. For example, on the left side you see this is a screenshot of the entry, which was based on multiple reasons as we have discussed in lecture 3. So this is the properly drawn trend line. We entered on the break of the trend line, and we have stop over here because this was the significant level, so we need to have stop above this, and then this is the end of the space. We have first profit target T1 here, and after that we have second target. It's a complete measured move. After that the extension, and still we can go for third target here, and we can trail it with the 8 exponential moving averages. So if we see here, this is the same picture after market progress. This was the entry, this is the exit on right side. So here we see T1 is achieved. After that we had the measured move here, so this was the T2 achieved, and still if it was, for example, 3 lots trade, so we entered 1 lot here, 1 lot here, and third lot we kept it open, expecting market could further move below, and for protection we put a trailing stop based upon 8 EMA. So if you have not so far studied the exponential moving average, please go back and watch my related lecture on moving averages. So here we see in this candle the close was above this yellow line, which is 8 EMA, so we exit the trade here. If it was going to make a rotation zone again like here, maybe we could have ended up in further profits, but still it's not. So still we ended in reasonable profit. So this is like the trailing stop. So likewise, if we must, save the screenshots, which are really helpful for the future analysis, and it's a vital part of our trading journal. Then risk limits, whatever weekly and monthly and overall. Then the trade result, whether it was profit or loss, opening equity, closing equity, account number, broker name with some emergency number as well in case something happened to the trading platform or your internet shuts down or anything happen. You should have a contact source and the person. Then expected win percentage, total trades on monthly basis, winning trades, losing trades, so on. We proceed. Maximum drawdown, average losing trade, maximum profit in a trade, average profitable trade, winning streaks, like consecutively how many trades in a maximum row you made profits, likewise losing streaks. And we strongly recommend not to have more than 3 losing streaks. If you made a loss in one trade and second trade and third trade, you should be a bit more conscious, because if it keeps on, it's not only adding to your loss, it can deteriorate your performance as well as your confidence, which is the main pillar. Then how many, long plus mean how many trades you ended up with profit, which you started with the buying. Likewise long minus. You can write any terminology you want. This is just I personally have been using for years. Long negative, you opened up a trade in long side and it ended up in loss. So number, how many trades. You fix this sheet, revise it every month, so you will have monthly numbers. Like how many trades you enter with selling position and they ended up in profits, and short negative likewise. Then monthly P&L in shape of percentage. And for that particular trade, if there is any fundamental major key indicator to watch, just write it down. If there is some economic release or anything which might affect, so you should watch it as well. Then entry journal reason, strategies, why. It's a combination of multiple things. Once I'll explain you that sheet, we'll discuss more details, but this is your personal note, like recognitions of any errors. This is one of the most important, that once the trade exit, and you write the exit journal with the reason. If you find any error or mistake, you should write one time you made a mistake, second time you made a mistake, and if you are writing maybe third time, you will avoid it, that this is something which I have been focusing on and it's continuously not working and ending in loss due to this reason. So maybe if you avoid that reason in future, it can give you better results. So all these things, and you can add some technical indicator details as well, which I have not written here, not to make it more lengthy. And in fact, many other I use which I didn't mention here, not to make it long, but it depends upon you. Gradually you can add more element to your trading journal, and you have to update it trade on trade basis and review at least weekly. Maybe over the weekend, if you at least give 30 minutes with the full concentration, this is fair enough, and you will feel drastic change. Believe me, it will change your trading activities and the results drastically. And if you are not writing all these things like most of the novice traders, then you might end up in losses. And by adopting this discipline, you will have hell of difference. Summary, whatever we have studied in this fourth and final lecture of the basic class. Risk is not managed in number of ticks. Trading is not about money. Here, let me explain this first line, because most of the traders I have personally seen are losing because they say, okay, we are trading euro and our profit target is 30 pips, that's it. And loss is 20 pips. Very simple. No need to go for any hassle. So this is the laziest approach. They, violate too many laws, what we have discussed. They don't need to go for risk reward ratio or percentage risk. They are going for fixed position, say every time they enter with 2 lots, and our profit target is 30 pips, and that's it, and loss is 20 pips. Now let market decide. This is wrong. This is a blunder. So trading is not about money, it is about markets. Detachment from the money is the start of your gut. Apathy about the money is the end of your trading. You should manage your emotions to make a rational trade plan. The key to risk management in any market is position size based on a percentage of capital. We looked at the concept of reward to risk ratio and how to properly calculate it. We finished teaching how trade expectancy is calculated and how it can help the trader determine possible outcome of their trading. One of the most important concepts is to never increasing your risk and moving the stop farther away once the trade is placed. The concept of trade plan and goal setting. We learned about how to plan your trade and trade your plan. We discussed the feedback loop and its components. A trading plan is an evolving document and describes how you are running your trading business. So take your business seriously. Studied the importance of writing the trade plan and improving by dedicating time at least weekly. Finally, we learned what should be included in trading journal. We'll have a separate video on trading journal. And this is the end of our basic course comprising 4 lectures. I would strongly recommend to go watch all these 4 lectures at least 2 to 3 times. After that, you will have strong grip on many ideas and then start implementing it initially in simulated account or sim account or demo account, whatever you call it, and then apply in your real account, and you will see that this is the business for you then. So have discipline and control your emotions and increase your knowledge gradually for a successful career in it. Wish you all the best, and after this series I will start small topic videos as well. But I again recommend any trader who wants to come into this business must at least see these 4 videos 2 to 3 times and then make a basic plan and proceed with this. Thanks for your time. We'll see you in the next class. Bye.